Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and of course, a little bit of crystal ball gazing. In that order. Today is Tuesday, January 14th, 2025. Today's episode begins with I wanted to talk about EWZ. If you're a regular watcher of my show, you know that I am long Brazilian equities. I believe this is a highly undervalued area of the market. Right now, this fund has an 8.9% dividend. And no, you didn't hear me incorrectly. This is an index fund of stocks of an entire country that is yielding almost 9% dividend, all while the S&P 500 is somewhere around 1%. Yeah, 1.2%. You know, with a near 9% return on dividends, if you held this for 10 years at this price, and they continued to pay the same dividend, assuming all of that together, you would make your entire investment back. You double your investment in 10 years. Plus, there is the fact that typically prices go up, typically earnings go up, typically dividend payments go up. So the undervaluation here for an entire indices of stocks is just, it's an incredible opportunity. And I just wanted to bring up the chart today because when we zoom out from a historical perspective, this is on a non-adjusted dividend basis. We can see that we are near all-time lows. In fact, 2020 lows of the COVID crash were about where we are today. And the last time we were around this area before that was as far back as 2015, 2016. I added some BRZU to my portfolio today because I realized that, since the recent decline, and it looks like, from a basic chart pattern standpoint, that this looks like it could be a bottom here. I don't know if it is or not. It's really hard for me to imagine this going any lower in price. And so why not add a little bit of leverage and bring my 9% closer to the 10% allocation, which has been my goal with Brazilian equities. So just wanted to bring that up as a first item. Second item on the agenda, Tuesday, PPI. Well, that's today, so I guess let's get rid of Tuesday. PPI. The PPI, this is a screenshot from Market Watch, came out a lot lower than the market was expecting at 0.2% month over month. The expected was 0.4%, and the last was 0.4%. This is how much the producers have to pay for stuff, and the core, excluding volatile food and energy, came out at only 0.1%, below the expected of 0.3%. I'll say this data created some intraday volatility, so going up and down within the day, and I think put a little bit of a slowdown in the rise of longer yields, although they still went like a tiny bit higher today. The market is still obviously waiting for tomorrow's data, the CPI, and that's the last item on the agenda. Wednesday, CPI is coming out. This is the more important inflation gauge because it says how much the consumers are willing to pay for stuff. That's the more important. The PPI can lead the CPI, but the CPI is the more important one to look at as far as what is inflation actually right now. And then we also have Wednesday, tomorrow, a lot of big bank earnings, including JP Morgan, BlackRock, Citigroup, Goldman Sachs, there shouldn't be a comma there, BNY, and Wells Fargo, all coming out before market open. And so the combination of CPI and all of those bank earnings can really, it could be a wild day tomorrow, or it could be nothing. I mean, maybe everything's going to come in exactly as expected, and nothing will happen. But I suspect tomorrow will be a fun day in the market, let's call it. No updates on the daily reminders, extremely important things for any active investor to be highly aware of. To watch me read through these daily reminders, watch the macro update 11025 with dominoes in the ball in the thumbnail. Also, no changes in the crystal ball ratings nor the Robschild portfolio. But as I stated earlier in the show, I moved a little bit of my cash to Brazil today into the fund BRZU. And as I've said before, I've been going more and more into a TMF. And I want to take a look at a longer term chart of this in a minute as well. Onto the charts, starting with the S&P 500. We all know it too well, this pattern that is playing out very beautifully, very much like clockwork, a head and shoulders top, breaking yesterday. And by the way that I had this line here, we tested, was the retest line. And so now it's expected for us to drop to around the 5,600 level. And this is like, even Tom Lee, I think, just came out, he's the perma bull. And I believe even he said something about getting down to potentially that level. I could be mistaken. I might be remembering Bitcoin. Anyway, lots of chartists are seeing this going to 5,600. And the way that I see it is, as long as CPI and bank earnings don't provide any crazy surprises, I kind of expect this chart to play out that way to the downside to 5,600. Next chart I wanted to bring up was crude oil. As we know, the past few days we've seen a rise because of problems with Russia, and we're no longer going straight up. This is not looking, we're losing momentum here. And so and a lot of good traders are seeing this as a top, and I'm not better than other chart readers or well, I guess chartists we'll call them, and so I'm inclined to believe them when they say that this is the top and we're expected to roll over here. And just from my eye, yeah, we're at least pausing here. I don't know if it'll continue higher or not. It certainly had a lot of momentum behind it. But yeah, we're no longer just going straight up, that's for sure. TLT, how low can you go? I mean, as much as I have 58% now in long duration treasuries, when things are low, there's no way of not feeling like, oh man, how bad is this going to get? But then you take a step back and you say, oh, what is a treasury bond? What is this thing that I'm buying here that is getting so cheap? Is there a risk of principal here? Yeah, I mean, there's more risk obviously with leveraged versions of it, but treasury bonds themselves have zero risk. And one big point that I need to emphasize here is that with the price down this low, it means that there are institutions and individuals that are selling treasury bonds with a lot of time left on them at a loss. It's not possible for them to not be selling them at a loss. This is what I consider to be a distressed asset. And whenever there's blood in the streets, when people are selling stuff not because they want to, but because they have to, and that's clearly what's happening here. I don't think that the people selling treasury bonds are in a position. No one is selling treasury bonds, let's say, right now and saying, oh boy, I just made a lot of money, now I'm gonna finally sell it and get out. It's not happening. It's not possible for that to be happening. We haven't seen this range in the fund, unadjusted for dividends fund, since its almost all-time low of in 2023. And of the fund's history, by the way, I misspoke the other day. This is the all-time low of this fund, and at least very close to it. Okay, so I zoom out, this exact fund started in 2002, and unadjusted for dividends. So by the way, the people holding it since 2002 are collecting dividends the entire time. So they're making money this entire time that they're holding it. When we adjust for dividends, you can see that they've made, that much money, going from $38 to $85. But unadjusted, we're as far as the dollar amount on your screen goes for owning this specific fund, it's at the bottom of the history of this fund's range. I heard one other trader very recently, I think it was Figuring Out Money. He has an amazing channel. Go check his content out if you don't know who I'm talking about. I believe it was him that mentioned yesterday this could be like a once in a generational type of opportunity, and he's absolutely right. I have to step back and take the emotion out and just think through, like, why am I loading up on treasury bonds here? It's like, there's two future possibilities. Either rates are going to keep going up higher somehow, and the value of these bonds are going to temporarily lose some value, or the value of these bonds is going to go up, and I will make a handsome reward, as they say. It is very hard for me to imagine treasury bond yields continuing higher or much higher from here. It's extremely hard for me to see that. Part of the reason is the potential returns that you can get in the S&P 500, all while all inflation metrics are not showing further runaway inflation. That isn't happening. This is also during a period where most other central banks around the world, their rates are a lot lower than 5%. I believe in China, they're only about 1% right now. And so people are willing to get a 1% guaranteed return on the Chinese yuan versus they're not, we need a 5% return for treasuries for the US dollar. I mean, really? The world's on its head right now. And it's it seems like a once in a lifetime opportunity. So that's why I'm in it 58%. But anyway, what do I know? Maybe I'll turn out to be wrong, and I'm okay with that. But whatever. That's all. I don't have anything else for today. CPI tomorrow. Tomorrow things could get extremely interesting. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching. See you next time, Robschild.